Hi, this is Billfoot. In this episode, I want to walk through the estimation of price elasticity of demand. We're going to do it in two small segments. One is the overall calculation, just to get the mechanics out of the way. And then we're going to dive a little bit more deeply using those mechanics, building up some, shall we say, reasoning for the mechanics and then some insights because of that reasoning as we apply it to a different case when we've already looked at in other episodes of hailing a cab, of all things, in New York City, of all things. So, price elasticity of demand is a statistic. And it comes from the notion, the big question is how sensitive is demand to price? Not not the question if there's a change in price, what is the change in demand? We're going to see that that's just the slope. And the slope has always been in our simple existence here in a linear demand curve, if that's what we think is the trend, constant. So elasticity, is that also constant? Is sensitivity, that's elasticity, is that constant? And we're going to find out that it is not. So the question of how we might, for example, price goods in the marketplace, given just a simple linear version of demand, if that's the trend, many misperceptions can ensue, but if that's the trend, is there an implication for pricing, for example? And thus with revenue? And the answer will be, oh yeah, big time. Let's walk into this. Uh, we're talking here about soybeans, and suppose our revenue depends upon soybeans and their availability. And there's all sorts of reasons for that. We go and get some data, very simple data, and we find, for example, that across two versions of the market, one in June 2024 and one in June 2025 in the US market, we see that the price, and these are measured in terms of US dollars per bushel, $11.20 in June of 24, and the quantity supplied is 4.26 billion bushels. That's a lot of soybeans. 2025, June, we go from June to June, $10.25 price. And we see that supply has gone up, yet prices went down. Ooh, very interesting. Do we have a demand curve? Do we have a supply curve? We're not going to try to answer that. And we can get various pieces of data. There's a lot of places we can go for data for this. And we can call up somebody in the business. Introduce yourself. Hi, just curious. Okay, so here is the infamous midpoint formula. It assumes a direction of causality, though, that prices rule quantity. In a very short run, that's probably okay. There's some markets where it doesn't even make sense. But in this market, it might be okay. It's a highly commoditized market. Soybeans are soybeans are soybeans up to a point. There are qualities of soybeans. It's just like the quality of hydrocarbons in the ground, quality of types of phone plans that we might have for our smartphones. But we're going to say for the moment, price is a major causal factor in how much quantity is demanded. Okay. And it's really more of an hypothesis. And that right arrow there is causal. Statistical is different. Here we'll use subscript 2 for year 2025, subscript 1 for year 2024. And what we're going to do is measure the percent change. This is a proportional version of what otherwise would be a slope. The slope is just Q2 minus Q1 over P2 minus P1. Notice we're doing this in terms of a base, which is somewhere between 2 and 1, Q2 and Q1, 2025 and 2024, halfway in between. Same with the price, halfway in between. Okay. Now, finance people will recognize this immediately as, at least on the price side, a return, a rate of return. It's a growth rate, and growth can be positive or negative. If it's negative, we colloquially say there's a decline. But it's a growth rate, and it really is comparing two growth rates now. And growth rates are proportionate changes, not just relative change, relative proportionate. And it's proportionate because it's change relative to an amount, change relative to an amount, and thus the two growth rates are compared with one another. Well, very good. Here's an R formulas, which I just left inside this document, which is available upon request. We can see we have a calculation of, I'm using Q here because I don't know whether Q is supply or demand really, but we'll see. And we see it's a negative 0.1055. Okay. We're going to say that's not very strong. It's actually a pretty weak sensitivity. But here's the calculation. The point of this is to go through the mechanics. So we have $4.30, $4.3 billion bushels in 2025 minus 4.26. So bushels have gone up, quantity. And we can see that's a very small growth rate in a year, 0.009, less than 1%. And in the denominator, we see that prices have fallen because $10.25 a bushel is in 2025, and $11.20 a bushel is in, yes, 2024. And that's negative. We can see that's an 8% move down in a year. That's a lot of money associated with that. And we can see that this works out to minus 10.1055. And what this means is that if there's a 10% change, see, that's a proportionate change idea, 10% change in prices, there will be a 1%. We'll take this number times 10. It'll be a 1% downward proportionate change in quantity, which is what we observe empirically here. All sorts of reasons why this might exist. We might go to Bunge, for example. There we go. Bunge Global. We at Bunge, who we are. I wonder who the leadership team is these days. I'm not promoting this. I am just showing where to find things belonging at Bunge. Innovation, action on climate, all sorts of supplier codes. And we see that the management this day, and here they are. Oh, my goodness. Oh, no. Paul Mauger still. This is wow. And Greg Heckman is in charge. It is an international global organization of Bunge, and we can look to them in the investor center especially about the soy market. Better accept all those cookies if you want to see anything, and look at their financial news. They work an awful lot out of St. Louis and also White Plains. And we can look them up as BG on the New York Stock Exchange. And this is kind of, this is where you would get a little bit more information about why prices in the soy market are moving and bushels demanded and supply are moving. And that's where we go to. We go to some of these more causal reasonings as to why. Okay. And let's see if we can go backwards. And Bungie management, and here we go back. Okay, so that is crucial. These mechanics are interesting. They provide a statistic that is based upon something a little bit deeper than slopes, and now we're going to attempt to apply this to a totally different situation from another episode about the demand for taxi rides, to movements in taxi ride prices. And we dive deeper into this, yes. And in that example, we do have a slope. It's rise over run. The rise is the price, and the run is a maximum here, maximum price that consumers could possibly want, and a maximum demand in that curve. We're satiated at 1.2 billion miles. These are miles. And this seems to have a dollar, some sort of dollar dimension. We could look at that a little bit more. But it's all about proportion. That's the thing to think about. And some explanation about that. Well, this is kind of interesting. At low prices and high prices, we anecdotally find out that people want to, low quantities, high prices, we want to buy more. At high prices, at low prices, high prices, on the other hand, we want to buy less proportionately. That's just anecdotally. We see this in the marketplace. It is kind of the law of demand. It isn't simply price goes up, demand goes down. No, there's a proportionate issue. We want more, as proportionately, if prices are high, and we don't want so much more if prices are low. Okay, and that is an implication of the downward sloping demand curve. So if we want to tell that story, here's one way of doing it. Put this down a little bit. We have a demand here, price equals 5 minus rise over run, 5 over 1200 times Q. It's negative. Here's the demand curve going from 5 at the top, 12 at the horizontal break down here. That's the maximum demand at price equals 0. And the maximum price at quantity equals 0. Okay. And you can see there are two regions here around an equilibrium that we had already calculated at $600 and $2.50. Thank you, Paul Krugman and Robin Wells, for the example. And what I want to show here is what is the elasticity at this equilibrium. It turns out it is 1 for 1. But in this green region to the left of 600, less than 600, and above $2.50 in this green region, we see an elasticity of -3. And the midpoint here, with the midpoint formula, going from 0 to 600, 250 to 5, will yield a midpoint of $303.75, this elasticity of -3. And down here, if we apply the midpoint formula again, this time in the range of 600 to 1200, and from 250 down to 0, we get a midpoint of 900. That's pretty clear, that's right there. And 125, that's pretty clear, that's right in the middle of there. And we get an elasticity, exactly the reciprocal, by the way, of, this is 1/3, -1/3. I'm keeping the negative signs here. Standard practice is to eliminate them. I like the positive and the negative because demand elasticities and supply elasticities, positive and negative, there is a difference between the two of them. And we'll look at demand at some point in the future. But just notice where these two regions just touch at this oscillation point. Sorry for the differential geometry there. A point of oscillation of these two planes, we have very different behaviors. A 10% increase in this high quantity, low price region, a 10% increase in price will yield a 3.3% drop in quantity. 3.3. Exactly the opposite of what happens up here in the green area, where we have a high price, low demand environment, a -3 elasticity. And this means that a 10% increase in price will be equivalent to a 30%, just multiply the elasticity times the 10%, 30% increase or decrease uh, uh, in quantity demanded. Very, very sensitive. Very sensitive. So those are the three elasticities. And they go on to explain a little bit more how to calculate these. Again, these are the midpoint formulas. You get a numerator, a denominator, and a relative change. This is where we're diving into it a little bit more deeply. And we make that assertion that -1, well, it does compute to that mechanically, but does it make sense at that point? At that point of there's nothing more to change in minds of consumers at this point. They're right at that midpoint, and that is a spot where nothing seems to perturb them too much momentarily. Joan Robinson, accumulation of capital from many years ago, called this the tranquil point. It's a point of tranquility, but it gets disturbed very quickly, as we well know. Okay. There's going to be implications for revenue in a moment. And here's the -3 calculation. Okay. The negative comes out of the price move from 5 down to 2.5. That's the differential. And if there's a trick, that's the trick. 2 over -2/3 gives us 3. The 2 divided by itself is 1. 1 times anything is itself, and we get -3. And again, here is the interpretation. 3 times the percent change in price. 30% up or down depending upon which direction the price is going. Now we go into the yellow brick road, the yellow region from the green region, and we do the same calculation. Numerator change in quantity, denominator change in price, 2/3 divided by -3 gives us -1/3. Just exactly the opposite of these two. If we have a change in price, if we have a 10% price drop, we're going to get a 3% increase in quantity. That might not be enough to make payment. We'll see. And then here's the finale of this, actually. This is what we use this for. How do we price was one of the questions. Companies like Bunge and Wegmans and healthcare, anybody in healthcare, they ask this question because they've got to make enough money to cover the cost of services, plus some more because of uncertainty and with markups, in order to survive and to thrive and sustain itself. Profit's fairly important to do this. If you have no profit, you probably can't replace a machine. Oh, when it forces itself out of service and it's unexpected. Okay, that's some of the reasoning there. Here I have plotted a scheme of, absolute, no, that's not the vodka. I should put an E there. A set of, against quantity demanded, all of those midpoints. And we can see that this is actually 1 here, and it hits almost squarely. There's some rounding error there at 600. And we can see something radically different. This is a rich large space for pricing. This is a very small price movement space down here. So as you climb to maximum revenue, and that's on the secondary y-axis over here, as you climb, you're climbing, 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 and that climbing diminishes until you get to the top. It's always positive. But if you're after this, you can get negative revenue. Revenue changes are negative here. The slope here is negative, and it gets more so as you get down here to 0. And this is where elasticity is small. Elasticity is big, huge. It's minus 19 up there, by the way. And you can check these numbers, and that would be the exercise, to check a few of these numbers against the revenue. Now, this one will be easy to get, but if you take this one here, you see it's on either side. But maximum revenue is 1,500, which is equal to 600 times $2.50. Okay, this is in millions, by the way, so this is a billion and a half. Wow, that's a lot. Okay, here's our price and so on. But the takeaway is this. For pricing, you want to be in this range if you want to increase revenues. And here, you want to be in, you don't want to be in this range. In this range, you want to decrease price. I'm sorry, you want to increase price here and decrease price here. That is the rule. The problem is, are we here? Here meaning at this demand curve in this market. And if the trend is there, this is probably going to be your picture for maximum revenue. The misperception is that you really aren't here. You're misperceiving signals in the market. A further misperception is the timing of your perceptions are wrong. The data you have is old. It's perhaps corrupted somehow in your data systems. These are operational risks. These are market risks. Price moves are market risks, and credit risks may loom. Can people even afford your very large, expensive iPhone or other smartphones that are out there? Okay, because they're all quite expensive. Your computer. And that's a credit check. So there's a credit risk too. Are there political risks? Of course. Tariffs, other economic policies, the Federal Reserve, the Bank of England, the central banks in China and India, all can influence your perception of where your demand for your customers are. If you start seeing customers walk away, you know you probably misperceived your demand. Okay, somehow. So this is not the only thing we need to know, but it is an important thing for the economic connection to all of the other pieces of our decision making around pricing. And last but not least, let's at least not forget rather, if we forget this, we're in trouble. Slope does not equal elasticity. Think of the green large, yellow small, two different pricing policies. And with that, I think this is a good point to say, I think we've had enough, and a good point to stop. And thank you for your kind attention. And I turn you back to your regularly scheduled programming. Okay, take care and thanks. This is Bill Foote signing out of some microeconomics here. Take care.